morning and welcome to our REACH webinar series. My name is Krista Barnes and I will be your webinar moderator. With us from ConnectShip iShip today are Business Development Manager Jerry Dixon and International Sales Manager Clint Boaz. Our featured speaker today is Beth Pride, President of BCE Global. But first, we will hear from our own Jerry Dixon. Welcome, Jerry.
Thank you, Krista. Good morning and thank you for joining our first public REACH webinar. Once we complete our introductions, we are going to examine global trade compliance, what it is and what it involves. Then we'll move on to global trade processes and classifications, before finally moving on to how to solve the many challenges that exist with trade compliance. Today, we're going to discuss one of the most important and sometimes difficult and confusing topics in the supply chain, global trade. On this REACH webinar, we hope to impart valuable knowledge that will improve your understanding of global trade and the role we play in its process, so you can expand your global reach. According to a study published by the Institute for International Economics, companies that export not only grow faster, but are nearly 8.5% less likely to go out of business. If your business is not already engaged in global trade, the chances are high that there are international opportunities waiting for you. And it's very important to understand what is necessary to take full advantage of all of those opportunities. This morning, our guest speaker for REACH will guide us through key topics in global trade. But before we introduce her, Clint, can you help us understand what role does ConnectShip iShip solutions play in international shipping?
Sure, Jerry. Something that can't be overlooked. Your shipping system is an essential link in the process of global trade because it's shipping that connects the supply chain.
Right.
And I think our role in global trade begins with our support for carrier compliance. We provide our customers with access to over 200 carriers around the globe. So wherever you have chosen to do business, wherever you're shipping from, we can connect you to a carrier that you have selected to serve that location. We support shipping from over 190 origin countries, covers 6 continents. And almost all of our components support services for international rating and shipping. So that opens up a lot of trade lanes for doing business internationally. We also provide support for things like describing the commodities in detail and the terms of an international shipping transaction and submitting that data to the carrier. We provide support for basic customs documentation, including the electronic versions of those documents in a lot of cases. We support a lot of the cross-border consolidation services that the carriers offer too.
What if I'm in a country other than the United States?
It's a good question. So for whatever country you're in, we support the locale so that you're able to execute shipping transactions using local currencies, local units of measure, and we also support international character sets for printing documents in other languages. And a lot of our components even provide messages that are relevant to the user in multiple languages. So that's a lot of functionality that our partners and customers are working with every day that's really important in executing international trade transactions.
Okay, thank you, Clint. Whether you are currently engaged in international commerce or are planning to open up new markets abroad for your business, the subject of global trade compliance is a complex one to navigate. We have always been committed to providing you with the tools to enable international shipping. But today we want to introduce you to a recognized industry expert who can demystify this subject. With that in mind, it is our pleasure to introduce our featured speaker for this webinar. She is a global trade expert, author of numerous benchmark reports, white papers, and articles. She is quite a dynamic speaker who advocates that global trade compliance is an essential component of every company's corporate strategy. She is a committed educator in the field of global trade. We are very proud to welcome the president of BCE Global, Beth Pride. Welcome, Beth.
Thank you so much, Jerry. I'm super excited to be a part of this. You know, at BCE Global, we do things differently. First of all, we love global trade compliance. This is something we are extremely passionate about, and we want to bring that passion to you. So we provide expertise for global trade compliance policy, procedures. We do audits. We help with a lot of training, and we even help automate the process. So we work directly with your team, and we train them so that they can manage the import-export challenges of the future. I'm going to tell you a little bit about BCE Global. We were founded in 2005. Our mission is to enable global companies through trade compliance consulting. We provide on-demand services, and we're really flexible in how you want to work that all out. The goal is to help you quickly deliver really good value and let you move on to your next issue. We are licensed customs brokers. We have experience in developing global trade management and transportation solutions as product managers and executives, and we have operational experience at DHL, Hewlett-Packard, Expeditors, and Extreme Networks, to name a few. We provide support for both the export administration regulations, commerce shipments, and international traffic in arms, Department of State or defense shipments. We work with import into any country in the world, and we've helped a lot of companies implement trade compliance solutions. So our customers are in all industries. Anything that crosses a border that requires an export authorization or customs clearance into the country of destination, we help them move goods globally. And although we're based in the United States, nearly 20% of our clients are actually headquartered outside of the United States. And you actually might see your companies listed, but we work directly either with legal or tax and the trade compliance team. And if you are in shipping, you might not have a direct relationship with us. But our goal today is to get that relationship built, because trade compliance provides great services to the shipping department. So I'm going to talk now about why global trade compliance is important and what it is. So anything related to importing and exporting is trade compliance. And an export and an import is when an item physically ships across a border, but surprise, it also includes financial transactions and agreements. And it's not just about the physical shipments of goods. So when you have an export or an import, you take on additional burdens and responsibilities. And many companies get into international trade compliance and they don't understand what those responsibilities and obligations are. And so the biggest responsibility is you have agreed by making an import or export declaration that you will make sure it's accurate, timely, and complete. And many times you outsource that to a service provider, the freight forwarder, customs broker, and you just have no idea what they're really doing. So how can you ensure that your declaration is accurate, timely, and complete? Unfortunately, many companies have no idea whether they're actually doing that. So it's a big risk that you take anytime you want to ensure that revenue comes from offshore or that you source products from offshore. So my goal is to demystify all of this for you today. Also, the other thing is, regardless of crossing borders, you need to understand global trade compliance as it relates to economic sanctions and embargoes, because financial transactions can be sanctioned and can be embargoed. So even if you don't move something offshore, you may have a trade compliance sanction that you have to deal with. So I want to help you to take this challenge that can be really hard to understand and hopefully demystify it. So let's go a little deeper into importing and exporting. Imports are pretty straightforward. Imports are when any shipment coming into the commerce of a customs territory. So that means I move goods from Canada to Mexico, or I import goods into Switzerland from China. And so that physical movement of goods is an import. And the import doesn't have to be finished goods. It could be for purchase items. So you're bringing in widgets and gizmos that are going to go into your manufacturing process. It could be that you're getting demo units. It could also be that you're getting prototypes from one of your tier 1 or tier 2 suppliers. And so really important, it's not just orders you place, but it's orders that are shipments that are sent to you. So if somebody decides to send you a sample and you didn't ask for it, you are still on the hook for the import. And you might get those calls from the couriers or from a customs broker or a freight forwarder saying, we have a shipment for you, who's your customs broker? Those are the fun ones, and you want to really look into those so that you can make sure that the correct customs entry is made. Another wonderful thing, I'm going to divert into samples a little bit. One very fun thing that people do when they ship samples is the supplier may send it to you at zero value. Nothing has zero value from customs perspective. Everything coming into the commerce of a country has a value, and you have to declare a fair market value, whether or not you are paying for the goods. So for example, sample fabric, if somebody sends you 10 yards of fabric so you can determine if you want to upholster a car seat with it, they would have to declare the value that it would be sold for, or if it was put up for sale, on your import declaration. They can write sample across it, but here's the tricky thing with samples. If the sample could be turned around and resold because it's in a condition that it can be resold, then you have to pay on that fair market value. To import fabrics, for example, as a true sample, you would have to cut holes in that fabric to make it unusable. Similar to hardware, if you're bringing in hardware as a sample, you would have to damage that hardware so it does not function so that it can't be resold. So again, samples are something that you want to be very tricky about. And another common mistake, and I'll talk about duties in a bit, that people make is they want to lower a value of an item even though the item could be duty-free. So lowering the value doesn't change what you end up paying in duties. So really important, again, an import or an export doesn't have to have a sale, but it does have to have a value. For exports, it gets a little trickier. Exports is the movement of goods across a border. The goods can be tangible, such as a computer, or intangible, such as the software license to use the computer. And the value of the software should be added to the value of the hardware if it is installed on the computer. And if it's not installed, if it's sent in a shrink wrap and a commercial shipment of software, it would be a separate line on your export declaration. So really important to understand whether software is installed or not installed. That's a physical shipment of a computer with software. But export controls actually get even trickier because they are not limited to cross-border transactions. They actually include any item that is transferred to a foreign location or sharing knowledge, technology or technical data, either oral, electronic, or visual means. I'm going to actually go a little deeper into that. So if I decide to manufacture offshore, and as part of that manufacturing process, I have to give technical specifications to the location that is going to do that manufacturing. It could be a contract manufacturer. If you give those technical specifications to your contract manufacturer abroad, you actually may need an export license to disclose that technology. Another tricky one with exports is if you are sitting in a conference room in the United States and are discussing US technology with someone who is not a US person, then you may need an export license to share that technology with that person on US soil, because it is deemed an export to that individual's home country. So if the person is a Chinese national, you might need to get an export license to China to disclose any technology to that person. So we'll go on to the next slide. The biggest thing to understand about where to start with global trade compliance is classification. So importing or exporting anything, you need to know what the item is. And there's two types of classification. The first is the harmonized schedule. It's referred to as an HS or an HTS, and it is a number. It can be anywhere from 6 to 14 numbers. In France, they've got letters in them. It actually tells you what the item is. By looking at an HS number, I can tell you if it's metal or rubber or a finished product or piece of jewelry. It also tells you the duties and taxes that would be owed on that item. And it also tells you if there are other government agency requirements. So a classification of a CD-ROM drive would have a indicator that would tell me it also needs FDA approval because it has radiation functionality as part of the CD drive that need to be declared and cleared through the Food and Drug Administration. Lots of fun with this kind of stuff. So the HS tells you what the item is and what duties and taxes will be paid. The ECCN, or Export Control Classification Number, tells you the export controls on the item. So to import something, you need the HS number. To export something, you actually need both the HS number, or it could be called the Schedule B number, plus the ECCN number, so that the people moving your goods around the world understand the controls on the item. So every shipper has to classify their products. And here's the big thing. Many companies have a compliance department, and those compliance departments have a classification team that will classify everything that's shipped. The data would be sent, and your invoices for your shipments would have the correct classifications on them. If you don't have a compliance department, it's highly likely that your freight forwarder or customs broker is doing your classifications for you. It's also highly likely that they just don't have enough information to correctly classify your products and are making misdeclarations in your name. So I'm going to give you an example of a really bad classification process. So I asked at a shipping desk one day, where do you get your classifications from? And the shipping clerk was very, very helpful. He pulled up a list and said, if the item ships on DHL, we use this classification. If the item ships on UPS, we use this other classification. That is absolutely the wrong way to classify a product. The mode of transportation doesn't change what the item is. So you should have a list that says SKU number X is this classification, SKU number Y is this classification. And those classifications will stay the same unless the government, the customs, changes the classification of the item. And you'll know right away because the classification would likely be rejected. So again, you should have a list of your products and the classifications associated with it. So many, many cases, customs brokers make your declarations into the customs, into the country that you need to clear customs that you're importing into. So you've got to get that great data to your customs broker. I'm going to give you some horror stories throughout this entire presentation. Hopefully that will scare you straight. Hopefully it will also tell you, give you a perspective on how bad things can get. We've had here's my favorite example. So we had a company that allowed their customs broker to classify every one of their products and make their declarations. And then they got targeted by a private equity firm to be purchased. And that private equity firm, as part of their due diligence, said, we want to look at your customs entries and we want to make sure you've made accurate declarations to customs. This is becoming more and more common in acquisitions of companies. So when they looked at what the customs broker declared versus what they should have declared, they actually uncovered over $1 million in duties that needed to be paid that were underpaid because of the customs broker's errors. And yes, the customs broker is not liable. The importer is on the hook to declare your goods correctly, accurately, and timely. Just because the broker didn't get a classification from you and decided to do it on their own to take care of you doesn't make them liable for errors. So that $1 million bill did go to the importer of record, came off the profit of the sale of their entire company. So we talked a little bit about harmonized classification code. So it also helps determine admissibility. Can this product be admitted into the United States? What's the duty associated with it? It also compiles the national trade statistics. So if someone imports something incorrectly, our trade balance statistics will be off. We know an auto manufacturer that actually made a mistake in their classification and said it was auto parts, not autos, and we looked like we had a trade imbalance between Korea and Japan and the US for cars that were being manufactured. When they corrected those declarations, it actually showed the US was ahead. It also determines, the HTS also determines compliance with trade preference programs. And I'm sure you've all heard of NAFTA or the Korean Free Trade Agreement. And so based on the harmonized code, we will know whether an item is eligible to partake in NAFTA or another free trade agreement. It also tells us about other government agency requirements such as Food and Drug or the Environmental Protection Agency. Export classification really controls sensitive commodities and technology. It does also help capture national trade statistics, and it identifies the proper export controls and requirements for licenses or other authorizations. So once I know an ECCN of an item, I can tell you based on the country it's going to whether or not a license is required. All commodities have to be classified. This means products, equipment, your technology, any software. This is stuff that is manufactured, owned, or just handled by the company. And it is worldwide, whether or not you are buying it, whether you are selling it, whether you are shipping it, whether you're just transferring it. We've had cases where people have shut down a US factory, moved the equipment to China. They've gotten export penalties because the goods required an export license to be in China. So just a reminder, you should know what your product is, and you should know what your product is when you conceive of it, when you decide to sell it to your market, so that you can determine whether or not it's a viable, profitable product to sell. So we'll go on to a little bit more about duties and taxes, because this is an area where many, many people don't understand. So when you import something, there are duties and taxes. Sometimes when you export, there might be additional duties and taxes. So China is a good example. We had a company who manufactured ink. And when they manufactured ink in the US and exported it, it was duty-free into all the countries that they exported it to. They decided to close down the ink manufacturing facility in Michigan, and they moved it to China. When they moved it to China, the one thing they didn't manufacture in China was the secret sauce of the ink. They continued to ship that from the US to China. Once they manufactured their ink using that secret sauce, they went to export their ink to their global customers, and they realized that China had an export tax on US technology. That secret sauce was considered US technology and made the goods US, so that their expectation of being able to ship their product, their ink, globally from China disappeared, and they ended up paying a tax on the export of their ink, and they made it more expensive to manufacture and ship from China than in the US. And the really sad part of this tale is when they went to move the ink back to Michigan, Michigan said, no, that's hazardous material and we don't want it in our state. So they still have to manufacture in China. They have ink that is more expensive to produce than they can sell it for, and it's a bit of a conundrum. So just a couple thoughts there. I want to talk a little bit about duties. The duty is the tariff imposed on goods when transported across international borders. So the purpose of the customs duty has a very valid reason. It's to protect each country's economy, their residents, the jobs in that country, and the environment. So countries will assess a higher duty on an item if they think it's an issue for the environment, or if they think it will jeopardize jobs, or it will impact the economics of the country. So by adding a higher duty, it controls the flow of goods. And so especially restrictive and prohibited goods, by slapping 100% tariff on it, that kind of slows down the movement of goods. So the duty can be calculated on the value of the goods. So you can say, I've got a $100 widget, the duty rate is 4%, so $4 is going to be my duty. Or it's on the weight or measure of an item. So I could pay $40 per barrel of oil that I'm importing. Or it could be a combination of both. I have a 2.7% duty rate plus a 10-cent per meter rate if it's fabric. So again, if you don't have your products classified, you have no idea how the duties are going to be assessed on your product, and you have no way to tell your product management team or your executives how much it will actually cost to produce and import your product. So big, big things to think about. There are a lot of taxes. I'm going to talk about a couple times the taxes. There are value-added taxes, goods and services taxes. In the US, we have merchandise processing fee and harbor maintenance fee. This is all calculated on the value of goods, but it's not that easy. There are some countries that compound the calculation of the taxes. So tax 1 may be added to the value of the goods. So let's say it's a 20% tax on a $100 import. Tax 2 would be on the value of the import plus the $20 tax. So your tax 2 would be on $120. And then tax 3 might be on the total of tax 2 plus tax 1 plus the value of the goods. So it can get really, really, really expensive and add up very quickly. So you want to know all of the taxes associated with the importation of your goods and whether they're compound taxes or not. And you absolutely want to know them so that you can truly value your products. Another point, there are some taxes that have maximums and minimums, and then some taxes are refundable. If you sell your goods into the EU to a distributor, when that distributor sells your goods and the customer pays the value-added tax on the item, you can apply for a refund on the VAT, and there's a whole bunch of reporting you need to do for that. There's lots of strategies on how to mitigate duties and taxes through product engineering, through actual consolidations and things like that. But the reality is you can't even begin to think of how to reduce your costs unless you know what your products are, how they're controlled, and what their duties and taxes are. So again, are you paying taxes when you bring things into the country? Are you, what are the additional taxes you have? So I also want to explain landed cost is a concept that everybody should understand. And it's really, really important to understand the landed cost of your goods for anything that you plan on importing and exporting. So many companies don't really have a clue what the duties and taxes are. They may go to accounting, and accounting will take a guess, and they'll apply a flat rate across all their products. We think our imports are dutied at 2%, so we add 2% to every shipment. We think our freight is X percent. You want to actually work that out either at a product family level or at the actual product level, so you really do understand the cost of your goods. How do you get that information? So one thing I want you to know is you already have that information. Your customs brokers are legally required to send you your duty and tax bill with a copy of your customs declaration. So they are giving you this information. What I find in nearly 100% of the cases is that that bill goes to your finance department, and your finance department pays the bill. And then 30 days later, they shred the bill, or they archive just the top cover of the bill, and all those records, the record of your entry, what duties you paid, what taxes you paid, gets shredded. So there's a really important thing to be aware of here is when you import and export, it's an obligation, and you have record-keeping requirements. And in many cases, it's 5 or more years. So you should go down and talk to your finance department, and you should talk about getting copies of those customs declarations and getting those into a place where they can be retained and saved for the required amount for the years, number of years based on the country you're importing into. So again, it's amazing how few companies really understand duties and taxes, and you can be the hero at your company if you can figure it out and manage it well. So here's your way to come in and save the day. I'm going to talk a little bit about documents, and just to remind you, we absolutely want to hear your questions. So important if you have questions on anything that I'm talking about, that you put them in the chat so that we can answer them when we open it up for questions and answers. So once you have your classification, you'll now know what documents you need to prepare for your entry. So based on that classification, whether you need additional other government agencies or you're going to make a NAFTA claim, the list goes on based on your classification. And if you need a export license, do you need a declaration from Ministry of Health? The documentation is the way that you communicate your product classifications to your freight forwarders and your customs brokers, and ultimately to the governments that you're making declarations to. So your documents are key in ensuring that your service providers make accurate declarations on your behalf. Many companies will use a standard template in their shipping system, and they just fill in the blanks with whatever data, and then they ship. So I want to take this time to actually talk to you about why specific data is super critical, so that you don't just keep printing words on documents and not understanding the implications of putting data in certain fields. So I'm going to talk about the commercial invoice. So the first thing is the parties to the transactions. And this can drive if an export license is required and who the importer of record is. So if you are selling to a company that is on the denied party list, you need to get an export license to be able to sell to that party. If you are selling to a party that is in China and it is an item controlled to China, you may need an export license to China. So understanding who you are sending it to is really, really important. The seller, that drives who the exporter of record is. And again, obligations. If you are the exporter, there are obligations for record keeping, accurate, timely, complete declarations. So by listing who the seller of the goods is, you're identifying who is going to be on the hook for the compliance for the export of the goods. And that's likely going to be you, or if you're a distributor, it actually might be your reseller. So you want to put some thought into that. The buyer, this actually identifies who is going to declare the import. And if you are putting random names on the importer, like a freight forwarder, who would actually not be the importer of record, then you are probably leading your shipment towards a delay, and you want to make sure that absolutely you have the correct importer of record as the buyer listed on the transaction. And if there isn't a buyer, you can list it as the importer. The ship to is where you're going to deliver the goods to. Many times people leave parties to the transaction off the invoice, and that can result in incorrect parties being declared as the export of record and incorrect parties being called to be the import of record. So again, really, really important. Some people list manufacturer. I like knowing who the manufacturer of the item is. It also helps you verify where the goods were really made. Manufacturer is also needed if you are making a duty-free claim. And I am the first person to step on a soapbox and say, don't claim NAFTA unless you know what NAFTA obligations you are going to be subject to. So call me if you have questions on that, or ask questions after this presentation. There's a field on the commercial invoice for harmonized tariff number and ECCN. And I can't tell you how many people just leave those fields blank because they don't know them, or they put only 6 digits of the number. So really, really, really important is that you go to your product matrix, buy a SKU number, get the HS number, the ECCN number, put that on your documentation so everybody in your supply chain knows what is being moved. And then the most left off field of everything is the license authorization. This will tell your forwarder if they need to get a license for exporting, or if there's a condition that needs to be adhered to. So an example is, there's a license exception called TMP for temporary. That can be used for tools of the trade. Let's say you're shipping an entire crate of tools for your field engineers to install or repair an item in Germany. When that crate is shipped, if the goods and the tools are subject to export controls, TMP can be used to get those tools to your field engineer to actually fix the goods. If you don't use that license authorization, TMP, your goods may be seized and may be stopped asking for a license. And so really super important, if you do have authorization to ship something that normally would require a license, include that license authorization on your commercial invoice. Very, very important. Country of origin is another field that many, many people mess up. So country of origin is not the country of export. Country of export is where the goods are shipping from. The country of origin is where the countries were produced. And that can be very, very tricky. So if I take a head of lettuce, the country of origin will be where that lettuce grew. Those are the easiest country of origin determinations we do. But let's say we make an entire airplane. An airplane is going to consist of parts from multiple countries. The wings may come from one country, the cables and the tubes may come from another country, the altimeter may come from an entirely different country. And so there are rules around the assembly of imported and domestic products that get put into that plane, and the content of the foreign and domestic products will determine what the country of origin of that plane will be, and where the assembly happens will also determine the country of origin of the goods. So very, very important. You need to correctly declare the country of origin, because the country of origin may affect the duty rate and may change the cost to your customer. Another field on the commercial invoice that is often messed up is Incoterms, and I'm going to get into those next, so hold that thought. One last thing I want to talk about is valuation. Valuation is super, super duper important because it can trigger a slew of issues. It can trigger holds, additional requests for information. So valuation should be based on what the price paid or payable was if you have a sale. And if it's items that are sent free of charge, it must be the fair market value of those items. And then repairs, it's the value of the item, or if you have it, the depreciated value of the item. You can add the cost of the repair to the transaction, and the duties would only be calculated on the cost of the repair, but you've got to get all that value information on your invoice, and you always, always, always have to use a fair market value. Also, the customs value of an item can never be zero, and it can't be an arbitrary value. So now into the fun stuff, because I love this fun stuff. So Incoterms is really, really critical. Incoterms, which is short for the International Commercial Terms, it provides a common set of rules used for defining the responsibilities of sellers and resellers in the delivery of goods under sales contracts. So Incoterms are applicable for both international and domestic transactions. And this is a pretty graph, and they distribute, and you'll see how it distributes and transfers risk during shipments regarding getting the goods from the seller to the buyer. So there are 11 Incoterms: Ex Works, FCA, CPT, all the way down through CIF. And the Incoterms that are pinkish are for all modes of transportation, and the Incoterms that are in the light blue, those are for ocean only. We often see Incoterms misused for ocean shipments, and you should definitely look and make sure you're using the terms for the correct mode of transportation for how you move your goods. Now, in the chart itself, you'll see the factory to factory and then all the processes in between. The trucker takes it to the warehouse, the cranes lifted on the boat, blah, blah, blah. So I didn't mean to say blah, 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 all the way through the supply chain. So you'll see on this chart that the darker blue are costs, the yellow is risk, and the orange is insurance. And those three elements, the seller is responsible for paying. The dark gray, kind of blue, the buyer is responsible for paying. So in this example, Ex Works, the seller pays for the costs at the factory, the risk at the factory, and the insurance at the factory, and they make the goods available at their dock. The trucker comes and picks it up, and the seller is responsible for paying all the other fees. The reality is that many exporters think that's the safest thing to do. But your sales contract most likely says you are responsible for getting the goods to your customers, in your customers' hands. But by using Ex Works, you have zero control over the movement of the goods. They pick the freight forwarder, they pay the duties, they make the customs declarations. So if stuff falls off the ship, if the customs sees the shipment, you may have to ship a replacement shipment to your customer. So really, really important there. And I recommend looking at how you move your goods and what you normally pay for and seeing if you're using the right Incoterms. So what are Incoterms? What are Incoterms not? So they are not payment terms. They are not freight payment terms. They don't transfer title. The transfer of title is determined in your sales contract. Incoterms do not address payment of foreign taxes, and they don't address compliance with the foreign regulations. Incoterms only say who's going to pay the bill from the transportation service provider, the warehouse, the insurance company, the carrier, the customs agent, the broker, and the tax assessor. So it's just telling you how to move your money, not who legally should be reimbursed for that money. Very, very important. Another important point, DDP, delivered duty paid, which is kind of on the lower 2/3, that says delivered duty paid. The seller is going to get the goods all the way to the buyer's door so that, and take care of all the costs. You might want to use DDP if you were doing a trade show because there's nobody to coordinate the import of the goods for a trade show. But the reality is you can't use DDP if you don't have a legal presence in the country because you wouldn't be able to be an importer of record without having a legal presence in the country. Now we're going to move to the next slide, and this is the disasters that happen where Incoterms are super, super critical. So if there's a disaster, a damage, an incident, Incoterms make sure who takes care of it and who pays for what when there's a problem. So the reality in Incoterms is that you may be responsible for and possess goods you do not own. So in example one, this is a free FCA term. And so an FCA, it means you're responsible to get the goods from the supplier's facility, and that title transfer doesn't happen until they arrive safely at your facility. So if you don't own the goods during transit, how do you make sure that those goods don't get damaged, and how do you protect your sale? Example two I alluded to on the previous slide is Ex Works, means you're not responsible for anything past export packing. But if title transfers when it reaches your customer's facility, that means you still own the goods and are not responsible for or in possession of any duties that you can control. So again, you really want to make sure. So what I recommend is you set up a Incoterm chart. Anytime you have a supply chain, identify your key stakeholders, finance, legal, trade compliance, and figure out where the risk is, what the sales contract says, and determine what the appropriate Incoterms is. So we actually create these supply chain matrices for our customers. We've had customers who had upwards of 50 different supply chains, and by building that matrix, shipping can actually determine the correct Incoterm to use. So defaulting to an Incoterm is absolutely the most risky thing you can do, because you may pay for damage for something that you didn't plan on paying for, and you might not have insurance for it. So I've got a couple more slides. We're going to move on to the trade compliance overview. And I'm going to just wrap up a little bit. For each transaction, there are 4 key questions you must ask. So what is the item that you're shipping? Are there any restrictions and controls for that item based on its classification, its value, its country of origin? Is the item's technology something that should not be shared without an export license? You want to know who you're doing business. Is the seller or customer in a restricted country? Are they restricted parties? Are the restricted parties people who you are not legally allowed to do business with, and you would need to get a license for? There are some tricky rules around restricted parties that I absolutely want you to know about. You need to know whether the party you're shipping to, whether restricted parties own up to or more than 50% of the company. Sorry, I said that wrong. If there's a denied party on a denied party list, and they own 50% or more of a company, that company is now considered a restricted company, and you can't sell to that company. Really, really tricky stuff around restricted parties. So you'll want to make sure you understand that process. Next thing you want to know about is where is the item going to or coming from. So this is where you deal with sanctioned countries. The current sanctioned countries are Cuba, North Korea, Iran, Sudan, and Syria, and waiting for the notice that Sudan might be coming off the list. So there would only be 4 countries that are subject to export controls. Don't take it off now. Don't start selling to Sudan until we get the official notice. The other question, the last question you want to ask is, what is the end use of an item? So be alert to transactions that are not described correctly. You want your customer to tell you why they're buying your product. If there's an abnormal circumstance, you actually might not want to sell to that company. So if you make semiconductors and a bakery wants to buy your semiconductors, that's a red flag, and you want to work through that and understand why they actually are using that. If you make even connectors and the person that's buying it, the end use, they say they're going to make a nuclear weapon, you need licenses for that. So absolutely understand the end use, and then understand if the product is going to be diverted. If it's going to be, they're saying they're shipping it to Germany, but they plan on diverting it into Iran. So really, really important questions. Understand those 4 questions before you actually export something. And somebody asked me a question that was very important. So does this all apply to goods in free circulation? So when an item is in the EU and going intra-EU, is it subject to these same 4 questions? And as a healthy global trade compliance business, I would say yes. You always want to know what your product is, who's involved in the transaction, where it's going to, and what its end use is, even if it's goods in free circulation. Now I'm going to move to just some effects of non-compliance. So trade compliance has a lot of risk, especially if you don't understand your responsibilities under the regulations. And so hoping that you won't get caught, well, that's not really a great strategy when you have to explain why you can't get your products into a certain market. Bad entities will get caught, and the penalties will be high. The government can levy criminal and civil penalties. They can take your assets. They can deny your import or export privileges, and they can suspend or disbar you from government contracts. But most important, any incidents of noncompliance can do huge, huge damage to your company's public image and your ability to fill your commercial goals. So really super important, regardless of not wanting to pay a penalty, because if you're good, you don't pay a penalty. But think of your company brand, and you want your brand to be known in a positive light. Just to give you an example, the largest criminal fine happened in a United States sanctions case. A company was shipping to a sanctioned country, and the penalty, small, it was this year, by the way, it was a small penalty of $1.19 billion, yes, I said billion dollars. These guys were blatant. These guys repeatedly violated the rules after they were told to stop violating. You're not going to do that. And if you put together a trade compliance program, it's really going to protect you. It will help you to ensure that you don't get any kind of penalties. So you don't want to be the one to let this happen. Put in a trade compliance program as soon as you can. And then I'm going to take you to the closing slide. Basically, compliance is your obligation. And all compliance revolves around you correctly classifying your products, stating the correct country of origin, and declaring the correct value. And this all has to be communicated through your customs brokers, freight forwarders, so the government gets the correct declaration. So we recommend that you take a risk-based approach to establishing a compliance program, that you classify all your products first and foremost, so you know your duties, your taxes, and your export controls. And then based on that, implement what you need to ensure so that you can ensure that your goods get to where you need them on time and legally. Now I'll pass it back to Jerry and Clint.
Outstanding. Thank you, Beth. Appreciate you took time today to give us that very valuable education on global trade compliance.
Sure.
ConnectShip is committed to providing you with the tools to enable international shipping. Now it's up to you to use the tools and knowledge we've shared to open new global markets for your business.
So here's a question, and maybe this is one that's best fielded by Beth. Question is regarding country of origin for items like collectibles. A hockey stick may be bought in Canada for $100, but the value at auction becomes $5,000 since an American player used it. So what is the country of origin, since most of the value comes as a U.S. object?
So I love this question. So I'm going to answer it. You're going to get a twofer for this. So country of origin question, the hockey stick was made in Canada. The fact that a American hockey player touched it does not substantially transform the item into a U.S. made item. But I want to extend the answer to valuation. So the valuation rules say you must declare the price paid or payable. So in this case, you have a $100 hockey stick that was sold for $5,000 in an auction. So let's say hockey sticks, and don't take me on this, let's say the hockey sticks are at 10% duty value. So you bring in your hard-won auctioned hockey stick in, and technically the price you paid is $5,000. So you would be paying 10% of $5,000 on that hockey stick. What I would recommend for your commercial invoice, and yay for giving such a big donation to whatever worthy cause that was, is I would put the value of the hockey stick and the harmonized schedule number for the hockey stick and put $100, and I would have a second line on your invoice that says donation, charity donation to the American Hockey Federation. I don't know that they need a donation, but whoever it would be, Boys Club of Canada. And so that your customs broker would make the declaration on the value of the hockey stick itself, not on the total donation amount. So hopefully that was a fun question that helped people to understand. The key is leveraging your commercial invoice so that you have more information rather than less information, so that you get the correct declaration made to the government.
Great. Thanks, Beth. So I have a question, and let me ask this of you, Beth, because I think that it's one maybe that a lot of folks in the audience might have. In your experience, how have companies that you've worked with gotten a handle on all of these issues related to trade compliance, whether it's classification or denied party issues, or dealing with sanctions or duties, and whether or not things can be imported between different countries. How have you found that folks have tackled those issues in your practice?
Yeah, and that's so usually there's no trade compliance person in a company, and people are shipping and they're using ConnectShip and they're just getting things through, and nobody has told them anything about trade compliance. And then something goes horribly wrong. So from a customer satisfaction perspective, the horribly wrong thing could be your product gets stuck at customs at the destination, and shipping gets called, and they just don't know how to answer the question, and the goods get destroyed and don't ever make it to the customer. So in those cases, the shipping department realizes they need to understand how to better clear customs, and they start calling experts and asking how to do that. Or they go to the country and look up how to classify goods for that country. From a U.S. perspective, there's a ton of informed compliance publications on the cbp.gov website, on the export.gov website as well. From an export perspective, there's a lot of training available from these government agencies. As you go into different countries, depending on the first world versus third world problems, you will get a lot of training, say in Canada and the EU, not a lot of training in Vietnam, and they're coming up. Actually, they're getting better. So the reality is, if your customer has a problem, you probably are going to solve that faster. Another impetus to solve and build a trade compliance program is when you get caught. So we've had many cases where a simple late file of the export declaration results in a penalty notice coming into the company, and they're like, oh no, we got to put a compliance program in place. And so when that happens, when a government agency knocks on your door and says you have a problem, that's when we come in. We solve that problem, resolve it with the government agency, but then we recommend you do a risk analysis of your operations. What are you doing? More importing, more exporting? What are the commodities that you're exporting? What are those classifications? And what are the additional requirements you have based on those classifications? And then we'll help a customer put together a risk-based strategy on, this year we're going to classify all our products and determine landed costs. Next year, we're going to put together a license determination process. Next year, we're going to put together a whole automated ASN, advanced shipment notification process. So again, you don't have to, one size does not fit all. You don't just put everything in place on day one. Do a risk-based analysis, figure out where your risk is, fix that problem. Get a great program in place so that we can, you don't have customs coming and knocking on your door, and then move on to the next hotspot. We have a lot of shipping people that get voluntold that they are now in charge of trade compliance. And so taking trainings, that's one of my favorite lines. And then they get to add it to the resume, which is wonderful. So again, don't wait for that bad event to happen. It's really, really critical to be proactive and explain to your company the risks that you are taking with not having classifications, not having country of origin, not having the value correct on your shipments. And it's impacting your clients. It could impact your supply chain costs, your bottom line. So hopefully this presentation has given you some input that will give you a baseline to draw from to talk to your senior management.
Great, thank you. So that seems to be the last of the questions that have been posted during the webinar, and we're coming up on the end of our time here. So we would like to conclude the webinar and thank each of our attendees for joining us today, and our guest speaker, especially Beth. Thank you very much for providing the information. And be sure to mark your calendars for our next webinar. It will be on November 9th, and information will be available on the ConnectShip.com website about that very soon. So those on our mailing list, you should see an email announcement and invitation on that very soon. Thank you very much, everyone, for joining.